In this video, I'm going to talk about leveraging capital structure for a firm. So a firm's capital structure is the mix of debt and equity that the firm uses to pay for its assets. So if you think of the balance sheet of the firm, on one side of the balance sheet, we have the things, the sources of capital, the debts the firm has taken out, and the equity that it's issued. And those are used to pay for the assets on the other side of the balance sheet. Because the value of the firm is maximized where the weighted average cost of capital, or the WACC, is minimized, the optimal capital structure is the mix of debt and equity that minimizes the weighted average cost of capital, because that's what maximizes the value of the firm. So we're going to start off with a very simple example of a firm that has no debt and the proposition of it taking on debt. And so we've got an example here that says the current situation, the firm has $10 million in assets, it has no debt, and it has equity on its balance sheet of $10 million. So the $10 million of equity probably consists primarily of things like retained earnings, money that the company has made in the past, earning income, and then rather than paying it out to investors, it's taken that money and it's purchased things like equipment and land and buildings and paid for the assets on the balance sheet using the money that it's generated, the income that it's generated. The proposed situation for this company is that it's going to take and issue $5 million in debt and take the proceeds from that issuance and repurchase equity. And so in the end, it's going to have $5 million in debt, $5 million in equity, because it's going to repurchase shares of stock with the proceeds of that debt. And it's still going to have $10 million in assets. And our balance sheet balances because the debt and equity sum to $10 million. In the first case, in our current situation, the debt ratio is 0. In a second situation, our debt ratio is actually going to be the debt of $5 million divided by the assets of $10 million, or 0.50. In the first situation, our debt to equity ratio is just 0 because it's debt, which is 0, divided by equity of 10 million. So it's just going to be 0. In our proposed situation, though, the debt to equity ratio would be equal to 1 because we take 5 million and divide it by 5 million to get 1. So when a firm repurchases its stock, it's going to buy it at the price that it's selling for in the marketplace. And so in this situation, the firm is repurchasing stock at $25 a share, and it's repurchasing $5 million worth. So we're going to calculate how much stock the company can repurchase. So I'm going to take my $5 million in debt that I'm going to issue. I'm going to divide that by $25 per share. And that gives me 200,000. So the company can repurchase 200,000 shares. And so the remaining number of shares outstanding will be 300,000. Because it can repurchase 200,000 of those 500,000 shares that are outstanding. And we're going to say that the company's interest rate is 8%. So on that $5 million of debt that the firm takes out, it's going to pay an 8% rate of interest each year. Okay. So in our first scenario, we have no taxes. And as we go through these different scenarios, we're going to get rid of it or change our assumptions about the firm that's issuing debt and repurchasing stock, just to see what happens to the firm as we change the situation. So our first situation is very basic. There are no taxes. There's no bankruptcy cost. And so we can see what happens in that environment. So in this portion here, the firm has no debt. Their earnings before interest and taxes, that's EBIT. If the economy does poorly and we're in a recession, they expect the firm to have an EBIT of $500,000. If the economy does as expected, just a normal economy, things are going okay, we expect EBIT for this firm to be $1 million. And if things go really well in the economy, we expect things to go really well for this firm. And in an expansion scenario, the EBIT, or the operating profit of the firm, would be $1.5 million. Since this firm has no debt, the interest expense for the firm is going to be zero across the board. The net income then is just EBIT minus interest minus taxes. And since there's no interest in taxes, net income is just equal to the EBIT for the firm. Okay. The return on equity, or ROE, is going to be net income divided by the value of equity for the firm. So our value of equity up here is $10 million. So ROE in this case is going to be 500,000 divided by 10 million, and that's going to give us a 5% return on equity. So I'll just show you this: 500,000 divided by 10 million. It's going to give us 0.05 or 5% return on equity. $1 million divided by $10 million is going to give us a 10% return on equity. And then finally, if the firm is in an expansion, our return on equity would be 15%. The earnings per share is equal to the net income divided by the number of shares outstanding. So up here, in our no debt scenario, we have 500,000 shares outstanding, and we have income of $500,000. So our earnings per share here is just going to be $1 per share. In the second scenario, we have $1 million in net income divided by 500,000 shares. So it'd be $2. And then finally, we have 1.5 million divided by 500,000 shares. And so our earnings per share would be $3. So that's our no debt scenario. Now we're going to look at the second, the proposition here is that we're going to take out $5 million in debt. And since our interest rate is 8% on $5 million in debt, so we can calculate what our interest expense would be. So we're going to take 0.08, our interest rate multiplied by our amount of debt of $5 million, and we get $400,000. So our interest expense, regardless of the situation with the economy, is going to be $400,000. So in the first situation, our net income would be $500,000 minus $400,000. And remember, in this scenario, there's no taxes. So we're not taking out any taxes in this case. So our net income is going to be $100,000. In our second case, the net income is $1 million minus the $400,000. So it's going to be $600,000. And in the last case, our net income is going to be $1.1 million. Which is 1.5 million minus $400,000. Our return on equity in this case, so remember what we did with the money, with that $5 million in debt, is that we repurchased stock. So now our equity for the firm is $5 million in the proposed situation. So we're going to take this $100,000 divided by the $5 million, and that's actually going to give us a return on equity of 2%, 0.02. And let me just show you that again. So I would take the $100,000 in net income and divide it by my $5 million to get 2%. In the second case, we have $600,000 worth of net income divided by that $5 million. And that's actually going to give us a return on equity of 12%. So 600,000 divided by 5 million would give us a 12% return on equity. And then finally, in the last case, we have 1.1 million in net income and a $5 million in equity. And so dividing the 1.1 million by 5 million would give us a return on equity of 22%. The earnings per share. So now we have, just to go back up here again, we have 300,000 shares outstanding after we repurchased 200,000 shares. So taking the 100,000 divided by 300,000 shares would give us an earnings per share of 33 cents in a recession. In the expected outcome, or the expected economy, our earnings per share would be $600,000 divided by 300,000 shares, or $2 per share. And then finally, in our expansion, we'd have $1.1 million divided by the 300,000 shares. And I'll just show you that calculation real quick. So I'm going to take $1.1 million divided by 300,000 shares to give us an earnings per share. We'll round it here at $3.67. So what we can see here is that as we go from a situation where we have no debt to debt in the capital structure, it increases the volatility of return on equity and earnings per share, two things that equity investors look at for the firm. If the firm goes into a recession, or the economy goes into a recession after the firm takes on debt, then the outcome for the stockholder is not good. They have a lower return on equity and a lower earnings per share. In the expected outcome, the earnings per share stays the same. The ROE for the firm with debt is a little bit higher. But generally, and we're going to look at this here in a minute, a stockholder would generally be indifferent between no debt and with debt in the expected outcome with an EBIT of $1 million, because they get the same earnings per share. The same level of earnings is available to them. Finally, in the expansion, with expansion, the economy expanding, the company doing really well, more of those benefits flow to the stockholders proportionally as the firm takes on more debt. And a good way to think about this is that no matter what happens to the economy, the debt holders, those investors that buy that debt, either it's going to be a bank that makes a loan to the company, or in many cases that we talk about, it's bondholders. Those bondholders' outcome doesn't change from the point of view from the company's point of view, regardless of what happens to the economy, because they're going to get the same coupon payment or interest payment. They're going to get the same debt payments, whether or not the company does really, really well, or if the company doesn't do so well, as long as the company doesn't go bankrupt, okay, or go into default on those debts. As long as the company is paying the debts, it doesn't really matter to the bondholder or to the issuer whether or not the company's getting a really high return, because their outcome doesn't change. Okay, that they still get that $400,000 in a recession. In an expansion, doesn't matter. Okay. In our example here, so the addition of debt to a capital structure increases the volatility of return on equity and earnings per share of a firm. Why does this occur? Because it concentrates the change in the EBIT across those different scenarios onto the stockholders. So the inclusion of debt in the capital structure concentrates the differences in the firm's earnings due to changes in the economy on the stockholders of the firm. So how does this affect stockholders? So what I've got down here is a little graph of the earnings per share of the firm with debt and the earnings per share of the firm with no debt. And the value of the stock to the stockholders in reality is generally fairly closely related to the earnings per share that the firm is generating. So if we know that if a company comes out on their quarterly reports and announces a positive surprise in the earnings per share, the stock price goes up. And if the firm announces a negative surprise on the earnings per share, the stock price goes down, because those earnings reflect the ability of the firm to either now or in the future pay out cash to the investor. Okay, so the earnings per share again reflect the ability of the firm either now or in the future to pay out cash to the investor, and so it's directly related to the value of the stock to the stockholder. So we've got this graph here, and this is a graph of the example above, so showing EBIT on the x-axis and the earnings per share on the y-axis. And here at $1 million EBIT is the crossover point, or the break-even point, where the two situations, the two scenarios have the same outcome in terms of earnings per share for the investor. If the firm has less than $1 million in EBIT in this scenario, then the stockholders are better off if the firm has no debt, so they have a higher earnings per share. But if the company does, or the economy does better than expected in an expansion, then the stockholders are better off if the firm has the debt that's proposed above. Okay, and we're going to, I'm going to show you the calculation now of where this comes from. So the break-even EBIT, this is the EBIT above which stockholders benefit from the firm issuing the proposed level of debt. And so it's going to change. This break-even EBIT is going to change based on the amount of debt that's being proposed. We're going to look at it from the point of view of this $5 million in debt, though. So the equation looks like this. There's shares outstanding when no debt has been taken out, multiplied by the interest expense of the amount of proposed debt, is divided by the shares outstanding with no debt minus the shares outstanding with debt. So this denominator is actually equal to the number of shares that will be repurchased with that debt. Okay. So using this equation, we can calculate the break-even EBIT. So the shares outstanding with no debt were 500,000 shares. So we have 500,000 shares. Multiplied by the amount of the interest expense was $400,000. And that's going to give us a great big number in that numerator. And then the denominator is going to be the shares outstanding with no debt were 500,000 shares. And the shares outstanding with debt were 300,000 shares. And so that's going to give us, and I'm just going to pull up the calculator here, a numerator of 500,000 multiplied by 400,000. So a great big number there, $200 billion worth, divided by, and in parentheses I'm going to put 500,000 minus 300,000. Close the parentheses there. So I get a value, a break-even EBIT of $1 million. And that's what we saw up above too. We saw the earnings per share between the two scenarios at $2 per share for $1 million, whether or not the firm had debt or not. So at that point, they would be the stockholders would be indifferent. If the EBIT was higher than $1 million, though, the stockholders benefited from the firm taking on debt. And if it was less than $1 million, the stockholders were harmed or received a lower earnings per share if the firm had debt than if it didn't. So now we're going to move into some theories about capital structure, and we go back to the 1950s where economists were starting to take a look at why firms took on debt and whether or not they should take on debt. So the main economists who started thinking about this and writing about this were two gentlemen, Miller and Modigliani, or Modigliani and Miller, or also known as M&M. So M&M were Modigliani and Miller, or again, Miller or Modigliani, depends on who you like better. And what they would do is they would start with a lot of assumptions about the firms and investors. And those assumptions would simplify things. They would make things simple so they could take a look at and think about what would happen with the firm and what would happen with investors if the firm chose to take on debt without having to consider things like, and we'll talk about this, taxes and bankruptcy costs and things like that. And then after, as they work through these theories, then they would add back in those, they would get rid of those assumptions and then account for things like taxes and bankruptcy costs. So that's what we're going to do here. So the first proposition that M&M make is called the pie model. And it's kind of straightforward. The idea behind the pie model is that it shouldn't matter whether the firm takes on debt, because you as an investor can create your own leverage for that investment that you purchase. So if a firm has no debt and you want to create leverage for that firm, you can do it on your own as an investor by just taking out a loan to buy the stock in the company. So the firm has no debt, but you think it should have some debt, or you think it would be beneficial for the firm to have some leverage. From your point of view as a stockholder, you can create that by just taking out a loan and using that debt to buy the investment in the stock in the company. And so what they said is that the value of the firm is determined by the value of the firm's assets. Capital structure doesn't matter because an investor can create or change the capital of the structure of the firm by taking on debt and using the debt to buy the stock in the firm. Their second proposition, M&M's second proposition, says that capital structure is irrelevant. And they said it's irrelevant if these assumptions hold true, that there are no brokerage costs or no commissions, no cost for trading stocks or bonds. There are no taxes. There's no bankruptcy cost. Individuals borrow at the same rate as corporations. No information asymmetries. And EBIT is not affected by debt. So let's talk a little bit about these assumptions. No brokerage cost. That certainly wasn't true back then. Back when Modigliani and Miller were making up these propositions, brokerage costs were actually pretty high. Nowadays, they're going down a lot. There's a lot of equity investments you can buy these days without paying a commission. But not too long ago, it would cost $20 per trade for you to trade a regular lot of stocks. So I'm talking about the 1980s, 1990s. It was pretty common that if you wanted to buy let's say 100 shares of Walmart stock, you'd pay a $20 fee. If you bought an odd lot, and what an odd lot is less than 100 shares, you'd actually pay a higher fee in many cases in order to do that. It's only been in the last couple of decades where the commissions for regular investors have gone down, and in many cases gone down to almost nothing, where you can buy and sell a lot of exchange traded funds and things like that with no commissions. So no brokerage cost certainly wasn't true with Modigliani and Miller. No taxes. That wasn't true either, and that still isn't true. Whenever you trade stocks, if there's a capital gain, you're going to pay a tax on that capital gain. No bankruptcy cost. We're going to get into detail of what bankruptcy costs are later on. But what you should know is that bankruptcy costs are real. There are costs associated with a firm going through bankruptcy, and those costs are borne by largely the stockholders of the company. Individuals borrow at the same rate as corporations. So what they're talking about here is individual investors borrowing at the same interest rate as corporations. This one's not a wild assumption. A lot of people can borrow at the same interest rates as corporations. So that one's generally true. No information asymmetries. So what no information asymmetries means is that everyone has the same information. It doesn't mean that everyone agrees with everything, but it means that everyone has the same information. The last one, EBIT not affected by debt. So in many cases, EBIT is not affected by debt. The earnings before interest and taxes, or the operating earnings of the firm, are often not affected by debt. And the example I like to use here is think about the last time you went out to eat. Did you ask your server or the person at the counter for a copy of the firm's financial statements? Okay. So if you go into McDonald's, go up to the counter and say, "Hey, can I see your financial statements?" They're going to give you a weird look. Okay. They're probably going to tell you no. And then secondly, they're going to, at the same time, they're going to give you a very strange look, because who would ask for that? Because most of their customers, and in fact, probably none of their customers, care about the capital structure of the restaurant that you're at. You just want your food. So in many cases, customers don't care about the financial situation of the companies that they're buying from. Okay. There are some situations in which EBIT is affected by the amount of debt and the financial situation of the firm. So I'll give you the example of General Motors back in 2007 and 2008. That was a situation where customers started caring a lot about the financial situation of General Motors, because the customers in those cases were, the first line customers are the dealerships, and the second line customers, the people buying from the dealerships, are people buying cars. They cared about the financial situation of General Motors, because if General Motors went bankrupt, then the warranties on those new cars wouldn't be honored, because those warranties are liabilities for General Motors. And this put General Motors kind of in a tailspin, because people were watching General Motors slowly not be able to pay their bills. And eventually what happened was that the U.S. government and the Canadian government had to bail General Motors out. And one big portion of this, to kind of get them through this storm, was that the governments had to come forward and tell customers it is safe to buy General Motors cars because the warranties will be honored. Because a lot of people were avoiding those cars because they thought, well, if I go out, I'd love to buy a new Corvette, but if I buy the Corvette, the warranty may be no good if General Motors goes out of business, if they go bankrupt, then they won't have to honor that warranty. And then if something goes wrong, I'm out of luck. So people started avoiding buying General Motors vehicles during that time, around 2008, because General Motors was headed and eventually went into a quasi-bankruptcy as a result. The governments of Canada and the United States ended up owning about 65% of the equity in General Motors for a short period of time to get them out of that situation. So the last one, I kind of went on a little bit about that, but the last one there, EBIT is generally not affected by debt, but in some cases it can be. So with all those assumptions in place, Modigliani and Miller said, based on this theory, the cost of equity is determined by the required rate of return on the firm's assets, the riskiness of those assets. We denote the required rate of return on assets as R sub A. The cost of the firm's debt is R sub D, and the firm's debt to equity ratio is D divided by E. So according to their second proposition, the required rate of return on equity, R sub E, is equal to the rate of return on assets. So if the firm has no debt, it's just the required rate of return on equity is equal to the required rate of return on assets. As the firm takes on more and more debt, the required rate of return on equity increases. Okay. Overall, they said the required rate of return on assets is determined by the business risk of the firm. So different companies will have different required rates of return based upon the riskiness of the assets that they own. And that riskiness is determined by the business risk of the firm. So business risk arises from the uncertainty in projections of the firm's cash flows. Business risk depends on demand variability. So think about companies that have products or services that fluctuate in demand over time or in certain situations. So for example, take snowplows. Okay. Snowplow companies actually have a lot of demand variability. If the weather is particularly warm in a given year, the demand for snowplows goes down. If it is colder and there's more snow to move, the demand increases. So the demand is not constant year to year or even season, definitely not season to season for snowplows. So there's a lot of demand variability. Compare that to something like water. Okay, so the demand for water doesn't change a whole lot, and it's not really dependent that much on the economy or the weather or anything like that. You might water your yard a little bit more in a drought or something like that, but the demand doesn't change a whole lot for something like that. Sales price variability. So the sales price of a product or service might fluctuate a lot. If you think back to 2021, 2022, there was a lack of computer chips, and so a lot of manufacturing of cars went down. Well, the sales price variability went up. The prices of cars increased dramatically during that time because car companies just couldn't produce cars because they didn't have everything they needed, but the demand was still there. People still needed to buy cars because their cars were breaking down and didn't make sense to get them fixed. So there was a lot of sales price variability as a result. Input cost variability. What this means is that the cost of the inputs going into the product or service that you're selling might fluctuate a lot. The inability to adjust output prices for changes of input cost. I like to use agriculture as an example here. I come from a family of farmers, and this is a risk that farmers face. My uncle grows things like soybeans and milo and wheat, and he doesn't get to choose what he sells his crops for. That's set by the market. They're commodities. Nobody cares that it's coming from his farm. He just has to take it to the co-op and sell it. Now, there are some things he does with futures contracts and things like that to lock in prices, but he doesn't get to pick the price. And the price may not actually adjust in the marketplace, may not adjust to changes in input cost. It's going to depend on what the demand for the product is that he's selling at the time, and not the cost of creating that product. The ability to develop new products in a timely, cost-effective manner. If companies can't develop new products in a timely, cost-effective manner, that increases the business risk of the firm. Foreign risk exposure. This is related to the amount of business the company is doing overseas, or dependencies that the firm has on supplies or things like that coming from overseas. Going back to the example of the computer chips in cars, this was one of the problems. There was a supply chain issue. Those computer chips weren't getting manufactured fast enough, and they were having a difficult time getting them over to the United States. And so this was a risk associated with having foreign manufacture of those chips. Finally, operating leverage. Operating leverage is the degree to which the firm's expenses are fixed rather than variable. So if a firm has a lot of fixed expenses, it creates an increase in the level of risk that the firm has, because the firm has to, in order to stay in operation, the firm has to generate enough sales and enough profits, operating profit, to pay those expenses, those fixed expenses. With variable expenses, the firm can adjust its level of expenses with its level of output. So kind of think like a fast food restaurant. And if times get slow at a fast food restaurant, one of the main jobs of the manager of the restaurant is to send people home. Okay, so if you're at McDonald's and sales decline, at some evening because the weather gets bad, nobody wants to go out, they'll start sending people home. And so they're reducing their labor cost with the reduction in the demand for their product. With a fixed expense, so say all the McDonald's employees were on salary, well, it wouldn't matter. They couldn't adjust without firing people, they couldn't adjust their operating expenses based on a decrease in the demand for their products. So business risk is determined by the management decisions and industry characteristics. This portion, RA minus RD multiplied by the debt to equity ratio, is determined by the firm's capital structure. As a firm increases its debt, the business risk becomes more concentrated on the stockholders. And then I say, see scenario 1 for an example. If the assumptions of M&M are true, then the firm value is not affected by capital structure. The firm value is just dependent upon the ability of the firm to generate operating earnings and the riskiness of those operating earnings, the volatility of those earnings. So in that case, capital structure is irrelevant if those assumptions are true. So now we're going to go into another idea here where we're going to relax one of those assumptions. And that assumption is that the firm pays no taxes. Now we're going to incorporate taxes. And in the US, this is actually a really big deal because companies get to deduct interest expense for tax purposes. And what I have here, it says corporate taxes and capital structure. Since interest payments on debt are tax deductible for firms, debt creates what's referred to as an interest tax shield for firms. According to Modigliani and Miller, the present value of the interest tax shield for a firm is equal to the firm's corporate tax rate multiplied by the dollar amount of the firm's debt. So that's what I have here. The present value of the interest tax shield is equal to T sub C. So T sub C is the firm's corporate tax rate. And D is the dollar amount of debt that the firm has. The interest tax shield increases the cash flows available to all of the firm's investors. And I'm going to demonstrate that in the following example. So going back to our original situation where the firm has no debt. So with the no debt situation, the interest expense is 0. Oops. So this is just 0 across the board. And then the next line is earnings before taxes. Well, the earnings before taxes is just the EBIT minus the interest expense. So it's, in this case, it's just going to be equal to the EBIT. Now the income tax is going to be 40% of their earnings before taxes for the firm. Oops. I'll just leave that alone. So the income tax is 40% of the earnings before taxes. So in the case of the recession where the firm has an EBIT of $500,000, the income tax is going to be $200,000, which is 40% of the $500,000. In the second case, it's going to be $400,000, which is 40% of the $1 million. And then finally, it's going to be $600,000, which is 40% of the $1.5 million. So the net income, if the economy goes into a recession for this firm, the net income would be $300,000. In the expected economy, the net income would be $600,000. And finally, in the expansion economy, the net income would be $900,000. So the equity for the firm would stay the same at $10 million. Okay, so the firm has no debt, going back to the original scenario. So our ROE would be $300,000 divided by 10 million, or 3% in the recession. It would be 6% in the expected economy and 9% in the expansion. The number of shares outstanding is still 500,000 shares. So my earnings per share will be 300,000 divided by 500,000. So it would be 60 cents here. Oops. In the case of the firm with the in the expected economy, it's going to be $600,000 divided by 500,000 shares. So that would be $1.20 in earnings per share. And in the last case, it's going to be 900,000 divided by 500,000 shares, or $1.80. Sorry about that. $1.80 per share. So that's the firm without debt. The firm with debt, it's going to look like this. The earnings before tax in a recession are just going to be $100,000 because they're paying out $400,000 in interest. In the case of the expected economy, the earnings before taxes would be $600,000. And in the case of the expansion, the earnings before taxes would be $1.1 million. Income taxes would be 40% of the earnings before taxes. So it's going to be 40% of the $100,000, which would be $40,000. 40% of the $600,000, so you take 0.4 multiplied by 600,000 to give you $240,000. And in the last case, it's going to be $440,000, which is 40% of the 1.1 million. The net income then is the difference between the earnings before taxes and the income taxes. So it'd be $60,000 here, $360,000 in our second scenario. And then finally in our last scenario, it would be $660,000, the 1.1 million minus the $440,000. So with our proposed amount of debt, we would repurchase 200,000 shares, so there'd be 300,000 shares outstanding. The ROE here would be $60,000 divided by $5 million in equity, so it'd be 1.2%. In the second case, it's $360,000 divided by the $5 million in equity. And I will not trust my brain to get this one right. So we'd have a return on equity of 7.2%. And then finally, in the last case, we have $660,000 divided by $5 million in equity. Or 13.2%. Our earnings per share, now we have 300,000 shares that we're looking at. So $60,000 divided by 300,000 shares would be 20 cents per share. $360,000 divided by 300,000 shares would give us $1.20 per share. And then finally, $660,000 divided by 300,000 shares would be $2.20 per share. So we have a similar outcome as what we had before with no taxes. The expected economy with the break-even amount of debt that we had, or EBIT that we had of $1 million, gives us the same earnings per share. If the EBIT is greater than that amount, then the stockholders are better off. They get a higher earnings per share than if the firm takes on debt than if it doesn't take on debt. However, if the EBIT is less than that break-even amount, then the stockholders are worse off. They have a lower earnings per share than they do if the firm takes on debt than they do if the firm does not take on debt. Overall, the cash flow for the expected outcome looks like this. And so what I'm looking at here is the expected outcome. That's our middle column above. So we're assuming that all of the earnings, the net profit for the firm, are paid out to the investors. And so this is referred to as a no growth situation, where the firm pays out all of its earnings to its stockholders. And we actually see some examples of this out there. Most firms are not no growth. They are they have some growth that comes from reinvesting funds. But we do have no growth situations out there where the firm is just trying to maintain its level of payout and it's not trying to increase those payouts over time. So that's the situation we're looking at here, a no growth situation where all of the income is paid out to the investors. So if the firm has no debt, the amount paid out to the stockholders in this middle column would be $600,000. The amount to bondholders is 0 because there's no debt. So the total amount being paid out is $600,000. If the firm has 50% debt, the amount being paid out to the stockholders, it's going to be down here, is going to be $360,000. That's the net income. The amount to bondholders getting paid out is going to be $400,000. That's the amount of the interest expense. And so the total amount being paid out is going to be $760,000. Okay, so we see the difference here in the cash flow being paid out to investors, both stockholders and bondholders. Between the two situations, there's $160,000 more being paid out to investors if the firm has 50% debt than if it has no debt. Okay. So where does this $160,000 come from? Well, the $160,000 is the interest tax shield amount for the year. So the interest tax shield for the expected outcome is $160,000, which is the difference between the amount of cash being paid out if the firm, I apologize, it shouldn't be tax, it should be cash, amount of cash being paid out if the firm has debt versus if the firm has no debt. Where that amount is coming from is the savings on tax. So if we go up here and look, the income tax for the no debt situation is $400,000. The income tax on the 50% debt situation is $240,000, and the difference between the two is $400,000 minus $240,000, which is $160,000. Okay, so that is where that $160,000 comes from. So because interest is tax deductible, a firm going from no debt to paying to having debt and paying interest increases the amount of cash available to pay out to its investors. And when I say investors, we're talking about both stockholders and bondholders. According to Modigliani and Miller, then, if we assume that there are no bankruptcy costs, then V sub L, which is the value of the firm with debt, and the L stands for levered. So V sub L is the value of the levered firm. I'll just type this up here. That's the firm with debt, is equal to the value of the firm that's unlevered with no debt. V sub U is the value of the unlevered firm. Or the firm without debt, plus T sub C, which is the corporate tax rate, multiplied by the dollar amount of debt. What's important here is that if we assume there are no bankruptcy costs. Okay. So if we assume that there are no bankruptcy costs, then adding debt to the firm always increases value. Okay. The key part there is if we assume that there are no bankruptcy costs. So where the value of the levered firm is the value of the firm with debt, V sub U is the value of the firm with no debt, T sub C is the corporate tax rate, and D is the dollar amount of debt, dollar value of debt. Based on this assumption, if TC is greater than 0, in other words, if the tax rate is greater than 0, then the firm's assets should be completely paid for with debt. Okay, which may seem a little odd. That may seem a little odd, but remember, we're assuming that there is no bankruptcy cost, that a firm can take on debt endlessly without it hurting its ability to operate. And if the company does go bankrupt, because we're not saying there's no default, we're not saying there's no bankruptcy, we're just saying there's no cost associated with going through that. So now what we do is we get rid of that assumption of no bankruptcy cost. And that kind of takes us into the next theory, which is a theory on capital structure that's fairly widely accepted. And it's called the trade-off theory. According to the trade-off theory, firms borrow up to the point where the tax benefit from an extra dollar of debt is exactly equal to the cost that comes from the increased probability of financial distress. So as firms take on debt and they have the possibility of financial distress, not being able to pay their debts, that increases cost for a firm. So I'll give you the example of Kmart a few years ago. So Sears was the kind of parent company of Kmart, and both Sears and Kmart have gone bankrupt. Before they went bankrupt, though, there was a very long and painful process of the demise of Sears and Kmart that went on for many years. And one thing that happened was that the suppliers for Kmart got worried. Because if you think about it, when a supplier sells inventory to a company and they offer them trade credit, so they give them time to pay on the accounts receivable. They issue an accounts receivable whenever the firm, like Kmart, buys inventory. The inventory is shipped, it shows up, they put it on the shelf, and then they often have something like 30 days to pay for it. Well, the suppliers were getting nervous because if Kmart went under and they had not paid those suppliers yet, suppliers may not get the money that they are owed. So they would be out their money and out their product there at Kmart. So what the suppliers started doing was they started restricting the sale on credit to Kmart. And the CEO of Kmart and the CEO of Sears, a gentleman by the name of Eddie Lampert, got very upset about this. And he said that the suppliers were taking advantage of the situation at Sears to their own benefit, and because they stopped selling to Sears on credit. Okay, so they stopped allowing them to have accounts payable. This kind of furthered the demise of the company, because then now they couldn't get inventory for their shelves without having to borrow money, and they were not in a position to borrow money to get inventory for themselves. So this kind of hurried the demise of the company because they didn't have anything to sell. There are costs associated with financial distress. One of those costs, like I mentioned, is just the inability to get inventory for your shelves. It's higher interest expenses or interest rates when you take on debt. It's worse credit situations if you go to buy things on credit and things like that. So there are definite costs associated with financial distress. We'll go through some of those costs here in a minute. So the trade-off theory, because it does incorporate bankruptcy costs, says that there is an optimal capital structure. And an optimal capital structure is a fixed percent of debt and equity that should make up the capital structure of a firm. So the other theory we're going to talk about is called the pecking order theory. And the pecking order theory does not assume that there is an optimal capital structure, but the trade-off theory does. The trade-off theory says for each firm there is an optimal amount of debt and an optimal amount of equity that the firm should have. Now, mind you, those percentages are going to differ between firms because there's different levels of business risk. The assets of the firm can be different and have different values if they have to be liquidated and things like that. But this says that there is an optimal amount of debt and equity that a firm should have. In theory, the optimal capital structure occurs where the weighted average cost of capital is minimized. Where the weighted average cost of capital is minimized, the value of the firm is maximized. So I mentioned that the trade-off theory does incorporate bankruptcy costs. So increasing a firm's debt increases the risk that the firm will not be able to pay its obligations and it will fall into bankruptcy. In the United States, there's two primary forms of corporate bankruptcy, Chapter 7 and Chapter 11. Chapter 7 bankruptcy is liquidation. Under liquidation, the firm ceases to exist. The assets of the firm are sold off, and the creditors of the firm are paid out as much as they can be. Okay. The assets of the firm are liquidated. That's why it's called liquidation. They're converted to cash. And the creditors of the firm receive payment to the extent that cash is available. Chapter 11 bankruptcy is reorganization. The company continues to exist. The company and the bankruptcy court negotiate with the creditors of the firm, and it's termed reorganization in part because the debts of the firm are reorganized. So you might not, if you're a creditor, you might not get the money paid back as agreed, but you're going to negotiate. And the idea behind this is that the creditors of the firm are better off in this situation if the firm is allowed to continue to operate. Okay, so that's a decision a bankruptcy court's going to make. The bankruptcy court, once a firm is in default and they're going through bankruptcy, the bankruptcy court's going to determine if the company is worth more dead or alive. If they decide that the firm is worth more alive, that the company will be able to at least put the creditors in a better situation than they would be if the firm were just liquidated and everything was sold off, then the bankruptcy court will allow the company to continue on operating. Many years ago, I worked for a company that went through Chapter 11 bankruptcy. It was not my fault. I like to tell people that. I was just an intern there in college. The company's name is Eagle Pitcher. Many, many years ago, Eagle Pitcher manufactured asbestos. And if you ever, have sat up and watched late night TV and saw commercials for mesothelioma lawsuits, you might have seen my company's name up there. When I was working there, these lawsuits were coming at a head, and the company, lost in the lawsuits and was told they had to pay out. Okay. So the company had stopped making asbestos for many, many years. It wasn't in that business anymore. It didn't do that anymore. We actually, the area I worked for, manufactured batteries. The bankruptcy court determined that the creditors of the company were better off if the company was allowed to continue to exist because we were a profitable company. We weren't engaged in the business anymore that had, caused all of the problems and unfortunately a lot of deaths. And so the people we owed money to were better off if the company were allowed to continue to exist, make profits, and make payments towards the amounts that it owed in the lawsuits. The company couldn't pay the amounts of the lawsuits immediately. It was a lot of money, and so would have been in default with its other creditors as well as the people who won the lawsuits. And so the bankruptcy court said the company was allowed, and it still exists today, was allowed to continue to exist, but we had to reorganize what we owed. And the management of the company changed. The ownership of the company, in fact, changed as a result of reorganization, but the company was allowed to continue to exist. In Chapter 7, the company is just sold off. All the assets are sold off. Everything is liquidated and sold off. And then the creditors are paid. So the direct bankruptcy costs are a result of, in some ways, the form of bankruptcy. Bankruptcy is a legal process. Direct bankruptcy costs are the costs that are directly associated with bankruptcy. These include the cost of paying lawyers and accountants and court costs. In the event of liquidation, this also includes the decrease in the value of the assets when they're sold, because we're selling them quickly in most cases. They're purchased at a discount, or they're sold at a discount to their true values. So if you think of certain assets that would take usually a long time to sell, they are often sold quickly. And I've been on the side of the lender in some of these cases where I've had to go in and liquidate a business. And, generally we just want to get out of it pretty quick. I worked for a bank. I was a loan officer. And I had to liquidate a couple of different businesses or assist in liquidating businesses. And oftentimes we would just have an auction, and we would auction off the assets of the company in order to try to get back as much money as we could. But we didn't want to take a long time in reclaiming our cash and getting our cash out. We just wanted to have the auction, collect what cash we could on that day, and then pay down the loan or pay off the loan as much as we could. But there's a loss there because we're not marketing the assets for a long period of time. We're not trying to find the right buyer for all of those assets. And so there is a loss in value to the investors of the firm in those cases. So those are the direct bankruptcy costs. The indirect bankruptcy cost can actually be much greater than the direct bankruptcy cost. The indirect bankruptcy costs are the costs associated with the firm being in financial distress and attempting to avoid bankruptcy. If a firm is known to be in financial distress, how might the following stockholders change how they engage in business with the firm? So I mentioned before customers. In a lot of cases, the customers don't care that the firm's in financial distress unless it's a situation where there needs to be a continuing relationship with the business. So I mentioned General Motors back in 2008. The customers in that case cared because there is a warranty on the vehicle, and so there's a continuing relationship. The threat of financial distress may turn some customers away if engaging in business with the company in financial distress requires a longer-term relationship. Another example of a situation where customers may be turned off if there's a threat of financial distress is if you're a contractor, a housing contractor, and you're, in financial distress. I probably don't want you starting to build a house for me because you might get halfway through the house and building the house and not be able to finish it. And that would leave me in a bad situation. And so I would want to make sure that I knew that you would be able to finish the job. You would have the financial health to finish the job. And also because, if there's any mistakes or anything that needs to be changed, that you're going to be around for a little bit to correct any mistakes with the construction. Suppliers, I mentioned this before with Kmart. Suppliers will often stop issuing trade credit or change the terms of trade credit if they think that their customer is in financial distress. So I mentioned that I was an intern at a company that went through Chapter 11 bankruptcy. One day I was sent to an office supplies store to pick up some supplies for the office. And prior to going through bankruptcy, they had issued us credit and they would just bill us once a month. And I remember the painful conversation I had with the manager there when I went to go and buy some office supplies for the company, and I tried to put it on our credit account. They said, no, we don't give you trade credit anymore because we're caught up in your bankruptcy situation. So that certainly happens. Employees. So think about it. If you're an employee of a company and it's starting to have financial problems, so hopefully you're still getting paid, okay, without any problems. But it's going to be harder and more expensive for the firm to attract talented employees if it looks like the firm might be going under. My doctoral dissertation was on the topic of executive compensation, and this is one of the things that I found was that CEOs going into a firm that were going through financial distress, having a difficult time financially, would require more extensive employment contracts that paid out more if they went to work there, and they use this as a form of insurance. So that they knew they were going into a difficult situation, and if things didn't go well, even despite their best efforts, that they would financially be okay, and so they would require contracts that would provide for that. Lenders and bondholders, they're going to require higher rates of return, or higher interest rates. So the idea here is that due to the existence of direct and indirect bankruptcy costs, as the firm takes on more debt, the required rate of return increase on debt increases due to the increased risk of bankruptcy. Additionally, as the firm takes on debt, the required rate of return on equity also increases because the stockholders take on more risk as well. The last theory we're going to talk about is the pecking order theory. I said the trade-off theory assumes that there is an optimal capital structure. The pecking order theory doesn't. The pecking order theory says that the form of funding that the company will choose depends on a pecking order and what they have available at the time. So according to the pecking order theory, firms don't have optimal capital structures that they target. Instead, firms choose the form of capital as financing needs arise based on preserving asymmetric information and financing costs. So that preserving asymmetric information, companies don't like to give out or make public information that they don't need to make public. Okay? And most of the time, this is to preserve a competitive advantage. Apple doesn't want you to know, or really wants its competitors to know, what's going to be in the next iPhone, what the features are going to be. They're very protective of that. The Coca-Cola doesn't want people to know what the formula for Coca-Cola is. It's a very well hidden secret. The Colonel at KFC doesn't want you to know what the 11 herbs and spices combination is for their chicken, because those are trade secrets and they want to keep those close and they want to keep their strategies close, so they don't want to have to share that information. And sometimes when a firm goes out to gather new funding, it has to share information in order to get that funding. If you go out, you start a business and you go out to raise funds, maybe you go to a bank and ask for a loan, that bank's going to ask for a lot of information. Or if you go to a set of equity investors and ask for an equity investment, those equity investors are going to want some information on the company in order to grant you the money that you're looking for, because they want to know that the company is going to be able to produce, generate returns in cash to pay them back. So the pecking order theory states that most firms will choose capital sources in the following order when financing needs arise. And I'm sorry, I mentioned financing costs. So different forms of capital have different financing costs. The first one we're going to talk about is retained earnings. Retained earnings is the cheapest form of capital to raise because it's just money the company's already making. So the first thing the company is going to do is it's going to use up its retained earnings. Retained earnings is just the income of the firm, and then they don't pay it out. They retain it in the firm. They don't have to share any information to retain earnings because it's already being generated by the firm. And there's no financing costs associated with it because they're not having to go out and issue new securities in order to get that money. The second is new debt. So there's not a lot of information a firm usually has to give out to get new debt. So this would take the form of either issuing additional bonds or taking out additional loans. Especially a publicly traded firm, a lot of that information that lenders would want to have are part of the financial statements that the firm's already generating and putting out there. So they don't have to often do a lot of justification for that money. The financing costs, there are financing costs. With new debt, you're going to go through an investment bank. They're going to issue bonds on your behalf, or you're going to go through a bank and they're going to issue loans. You're going to issue loans to the bank as the company. And there are some financing costs there, but they're generally not very high. The last is new equity. New equity, to issue a meaningful amount of new equity, the firm usually has to reveal a lot of information because it looks bad. Companies generally avoid issuing, like I said, a meaningful amount of new equity. Companies will sometimes offer small amounts of new equity, and that usually is for the purposes of providing shares of stock for their executives, part of their executive compensation plans. But a meaningful amount of equity for things like investment is something that companies often avoid. And I'm going to get into that here in a minute. So why does the pecking order follow this order? So like I said before, retained earnings, don't require the firm to share information. And don't have additional financing costs. New debt, the firm sometimes have to share some information on why they need the money, what they're going to use it for. But again, that's generally the amount in general is not that much, and the financing costs tend to be fairly low. Finally, new equity does generally require the firm to share information that it doesn't want to share. And the financing costs can be pretty high. I looked through the flotation cost, which is the cost of, the accountants and the attorneys and the investment banks associated with issuing equity for a firm, and it's oftentimes between 5 and 10% of the amount they get from the issue of equity. So it can be a fairly substantial amount. So the reason why it is expensive and it requires a lot of information for a firm to issue new equity is because investors don't like it. Whenever stockholders generally don't like it when a company issues new equity. So companies avoid issuing new equity for 3 reasons. The first reason is it dilutes the ownership, it dilutes the control of the existing owners. So if let's say a firm doubles the number of shares outstanding, if I own 20% of the stock, I have 20% of the voting power of that company, and if the company doubles the amount of shares outstanding, my voting control, my power has just fallen in half. Okay. I do have, as a stockholder in the United States, I would have a preemptive right to purchase shares in the amount that would maintain my control. But I don't want to do that as a stockholder. I don't want to have to keep buying shares to maintain my control over the company. So I don't like that, and stockholders don't like that whenever a company issues new shares that dilutes their ownership percentage of the company. So that's one reason why. The second reason is that it sends the signal that the stock is overvalued. So think of it this way: if you have something and it's selling in the market for a higher price than what you think it's worth, then you're more likely to sell more of it, or sell what you own of it. And that's the signal, that's the message that's sent by companies when they issue new shares of stock, is that the existing stock in the market is being sold for more than what it's worth. Because if you own something and it's trading in the market for less than what you think it's worth, you're not going to sell it. So for example, let's say you have a house and you think that it's worth $200,000. Okay. If the current market for housing isn't is not a seller's market, and let's say the value in the market is only $100,000, you're probably not going to sell your house because you believe it's worth $200,000, but the most or the amount you think you're going to get for it if you sold it today would be $100,000. You wouldn't sell it. However, if you thought your house was worth $200,000 and your house would sell for $1 million in the market, you'd probably sell it. You'd probably sell it as fast as you can because you would be making a lot of money and a lot of profit and generating a lot of value to yourself for doing that. Well, the same thing's true with stocks for companies. If a company's out there actively selling additional shares of its stock after its initial public offering, the viewpoint is usually that the managers and the directors of the company believe the stock price is too high in the marketplace. Okay, so it sends a signal that the stock is overvalued, and oftentimes what happens whenever a company goes out to issue new shares like that is that the stock price falls. Okay. Finally, the last reason why companies avoid issuing new equity is one I've already mentioned, that the flotation costs are high. It's expensive to issue new equity. So for those reasons, companies usually avoid issuing new equity. And to the extent that companies follow the pecking order, they'll usually exhaust their retained earnings first. Then they'll issue new debt. And then if they need additional financing at that point, they'll choose not to engage in new projects. So let's say the company has some really great projects out there to fund, but they don't have the money to do it. They've exhausted their retained earnings. They've taken out the amount of debt that they feel comfortable with. They'll just stop investing at that point. They'll choose not to continue to invest in projects. They'll pull back and not issue new equity because it's looked down on so much. Finally, so that's the trade-off theory and the pecking order. What research tells us that firms generally follow the trade-off theory in the long term, and they follow the pecking order theory in the short term. That there is a capital structure, an optimal capital structure that they kind of aim for over long periods of time. But in short periods of time, when a company needs cash today or needs cash in the near future to fund new projects, they're generally going to follow that pecking order theory in the short term. To give you a small example of that first part, many years ago, I met with the head of finance at Walmart down in Bentonville, Arkansas. And he said, ask me whatever you want. And I said, okay, how do you determine how much debt to take out? And he said, and I was a little surprised by this, he said, I call up Standard & Poor's and I say, how much debt can I take out and maintain a AA bond rating? So AA bond rating is a good bond rating. It's not a top, top is AAA bond rating, but that's the bond rating that Walmart wants. They want a AA bond rating. That means they're taking on a little bit more debt than would be allowed for a AAA bond rating, but they're not taking on a high amount of risk. So that viewpoint of targeting a specific bond rating is consistent with the trade-off theory because they're trying to manage the bankruptcy cost of debt relative to the tax benefit of debt. That's where I'm going to stop this video. Please let me know if you have any questions.